Okay, we are on page 4, and we're going to do example 1 with the intercompany profits that are realized and unrealized. So, on January 1st, year 4, parent company acquired 90% of the common shares of sub for $16,200. Now, on that date, the sub had common shares of 8,000, retained earnings of 4,500. Sub's equipment with a life of 5 years was found to be undervalued by 3,000. Parent company uses the cost method to account for its investment in the sub. Okay, so we need to write to fair value. So then it gives you the acquisition differential calculation, which you should know how to do by now. Notice here the sub's carrying value of net assets, we don't have their statement, so we just use the common shares and retained earnings and add them together, and then we take away the 3,000. Equipment, remember, it would be a 3,000 debit, so it would be, and we're taking it away to get 2,500. So make sure you know how to do that. That should be kind of second nature to you now. Kind of don't think about it. So now we get into the harder stuff, the different stuff, new stuff. So on December 31st, year 4, parent reported earnings from its own operations of $42.48. Sub reported a net income of $16.80 and declared and paid dividends of $90. Now this is new. The income tax rate for both companies is 40%. Goodwill impairment was calculated as $60 in year 4. So none of that's new yet. Let's see on so far where some of these schedules, what schedules this goes on. So this goes on changes in AD schedule. And we have to watch for amortization and impairment. Now, these dividends, do they get all of it? No, they only get $90 times 90%, which is 81. And we're going to need to eliminate that because it's part of the basic. Now, this 50 goes to the impairment on the changes in AD schedule. Okay. So, during year 4, sub made sales to the parent amount of 5,000, and then you stop. Always, when you see so-and-so or sub or parent made sales to the other one for X, that is a transaction, okay? So, upstream or downstream? It's upstream, and it's a basic transaction. Okay, so we know we're going to have to get rid of that one. Now it also tells you at a gross profit rate of 30%. So the seller, that's the seller's gross profit rate. And who's the seller? The sub is the seller. Remember, we need the gross profit rate because whoever makes that initial sale, if it's left, if there's inventory left in the circle, we've got to get that gross profit rate and throw it away, get it off the statement. Okay. Now, at the end of year 4, parent's inventory contained items purchased from the sub for 1,000. So this time the sub sold to the parent and their gross profit rate on, and here's inventory sitting there. It hasn't been sold externally. So, is that upstream or downstream? Parent's inventory, that means it came from sub, so sub sold, so it's upstream. And it's unrealized because it's still in the circle. Okay. Now, number 3, during year 4, parent sales to sub amounting to 4,000. So that is what? Downstream. And it's basic. And this 25% is the seller's gross profit rate, and this time the parent's the seller. We're going to need all these pieces to put it in the schedule. Okay. At the end of year 4, sub's inventory contained items purchased from the parent for $700. So, this is inventory. Sub's inventory at the end of the year contained items purchased from the parent. So, stuff sitting inside the circle. So, this is downstream, unrealized. Now, at the beginning of the year, sub loaned parent 100 and collected 10% of interest revenue. This 100 is a basic, and that's note receivable and note payable. And this 10% is going to be basic also. It's going to be interest, and we might as well just calculate it now. 10% times 100 is $10. So interest revenue is going to go down, interest expense is going to go down. Okay, so what they want, complete the following calculations or schedules. Changes in a list of basic transactions is optional, you guys, but I'll list it when you're starting out because they're so easy to forget. This is our new little piece of information. Realized profit schedule, or there's some, every question seems to call it a little bit something different. Company profit schedule. Which is fitting because in real life, everybody calls things slightly different. I mean, look at two companies, you're never going to find the same, what are they called? Chart of accounts. Okay, then we're going to do consolidated net income, ending consolidated returned earnings because we're not completing a statement of retained earnings. We need NCI on the balance sheet, and we need the consolidated income sheet for the end of year 4. So, let's see all our other information. Okay, on page 5 then, we have the financial statements for both companies, sub. You can see the investments there, the $16,200 we paid. Current liabilities and so on. One thing I just want to remind you is sometimes, because IFRS hasn't really solidified this, sometimes they list the equity first and the liabilities, so just when you're trying to do a question quickly, make sure you pay attention. Okay, so there's our statements, which we'll do later. And this is what we want to do first, changes in AD. So we need beginning balances, and this is where you look at your calculation of AD and goodwill. And the only two things you have on there under acquisition differential are equipment and goodwill. So we put equipment and goodwill, and the balance for equipment is 3,000, and it's positive because it's debit. And goodwill is 2,500. It's also a debit because it's an. Now, what do we have to do with the equipment? Well, we amortize it. So, 1,000. And how many years is it over? You should see it right under the top, the example. It's over 5 years, so it's going to be 600 per year. So, this was positive, this is negative because we're doing the next thing, which gives us 2,400. Now, I want to talk about this one before we go on. So, if on the subs books, remember, to get our consolidated statements, adding the parent statements from their own books to the sub statement, then putting them together, right, with some adjustments, and these are the adjustments. So, on the subs statement, is meant big or small in terms of being undervalued or overvalued? Well, it says it was undervalued. So this is too small. Right? Does that make sense? Okay. It was too small. Undervalued. Okay? So, the depreciation expense is too big or too small that they calculated. Too small. So we have to make, on the consolidated statement, depreciation expense bigger. And that makes net income go up or down. Down. So we want net income to go down. I'm just going to say it one more time, you guys. So, sub-statement, which is what we're working from to do a consolidated statement, is wrong, okay? And I'm using the little quotes. It's wrong. It's perfectly right for its own entity, but not for consolidated. It's undervalued. It's too small. So, we're making it bigger. But that means when we get to the income statement, the depreciation expense, they calculated using a little tiny number. So it's too small. Therefore, when we do the consolidated statement, we have to make depreciation expense bigger, and that'll make net income go down. Okay? Okay. So, now we get to the goodwill. Goodwill's easy. We've done this 100 times. This goes down by 50 from page 4, which means it ends up at 2450. And so this is 650, and this is 4850. And just a reminder, this stuff goes on the income statement, this stuff goes on the balance sheet. Now, if we have impairment, does net income go up or down? It goes down. Now, you don't have to put these here, like if they ask you to do this in Connect. But this is for us so that when we put it with our calculations, we understand what's happening. Okay. Just before we go on to the calculations, no, you know what? I'm going to change it right here. No, I'm not. I'm going to keep going. As you can see, I'm indecisive. So, list of basic transactions in year 4, and it's optional. So, we have, and now I just go back and I look here, and then you put basic, we write it down. So, we've got an upstream sale, and follow along with page 4 of 5,000. And we've got a downstream sale of 4,000. We've also got the subs loan to parent. We've also got interest on the loan and the subs dividend. Okay. Now, both this basic sales, we're going to make sales go down and cost of goods sold go down, like we said on page 1. Subs loan to the parent, on the balance sheet, we're going to have notes payable go down and notes receivable go down, just like we did actually in last chapter. Now we have on the loan, so we're going to have interest expense go down and interest revenue. And the subs dividend, we're just going to eliminate. This is kind of odd because it's kind of one-sided. The dividend of 81. Now, one question for you. Is this going to affect any tax? Has no effect